Are you living in the US as a Canadian? Your RRSP, TFSA, and other taxes may not follow you the way you think they do. Let's break down what you must know before you face a surprise bill from the IRS, as well as other costly mistakes to avoid. Hi, my name is Brian Haggard. I'm a certified financial planner, chartered financial analyst, and I'm the founder of Retirement and Financial. We help simplify your cross-border retirement plan. And today we're going to talk about some of the big mistakes that we see people make that could cost them hundreds, if not thousands, sometimes tens of thousands of dollars in penalties if they do things incorrectly. We're going to talk about how to fix some of those mistakes as well. So, here in the US, as a cross border financial advisor, we help our clients integrate both their US and Canadian retirement accounts together. And having an RRSP up in Canada and taking withdrawals from an RRSP is completely fine. Your RRSP is typically tax deferred, at least on the federal level. Some states may require you to report income on your state income tax if you have an RRSP, but for the most part, RRSPs tend to be just fine here in the States. The issue is when we are looking at somebody's retirement plan and they have a TFSA, a tax-free savings account up in Canada, that all of a sudden brings in a boatload of issues. First and foremost, we need to start counting that as a foreign trust typically, which is 8 pages of taxes or tax forms on the US tax return for every TFSA investment that you may have. But it doesn't stop there. If your TFSA gains anything throughout the year, you have to pay taxes, ordinary income taxes on those gains. TFSA has become quite a US tax nightmare if you have one. That's why a lot of people will get rid of their TFSA account either before coming down to the States or shortly after. The next big issue that we see is Canadian account reporting or the lack of it. If you have Canadian accounts up in Canada, as a US resident, you typically need to declare that either via on your tax return or an electronic filing. There's two types of declarations that most people will have to make. The first one and the most common one is what's called an FBAR. If you have over $10,000 of accounts up in Canada, and yes, that might include RRSPs, bank accounts, anything, LIRA accounts that you may have up there. If you have over $10,000 US dollars up in Canada, you need to report and file an FBAR every single year. That is an electronic filing made outside of your US taxes. If you have over 75,000 up in Canada, if you're single, or $150,000 if you're married up in Canada, you have to file what's called a Form 8938 each year, and that actually is included on your US taxes. The failure to file either an FBAR or 8938 each year can cause up to $10,000 a year in penalties. You can imagine those really start to add up. And it's important that if you are in the US, that you're filing these on a year-to-year basis. And if you haven't been filing these on a year-by-year basis, you go back and correct your mistakes. So I mentioned earlier that it's fine if you have RRSPs here in the United States as long as you're reporting them on a year-to-year basis. But what's not fine is the potential risk for double taxation on those RRSPs. When you withdraw those accounts here in the US, Canada will withhold a certain percentage up there, either 15 or 25%, depending on how much you withdrew down here in the States. Now, the issue is you still have to count that as on your US tax returns. And although the 15 or 25% being withheld by Canada will help offset some of those taxes, it still doesn't always avoid the double taxation issue that you may have. One of the big issues that we see is when people take large RRSP withdrawals out as a US resident when they also have a lot of other US income that year. What happens in that case is their US based income gets taxed additionally because of the result of the RRSP income, and the foreign tax credits don't offset a lot of that additional income they're facing down here in the States. Ultimately, one of the biggest mistakes that you can make is a large RRSP withdrawal when your US income is high. What we would prefer our clients to do is take those larger RRSP withdrawals out when they have little or no US based income, and that can help them actually take advantage of that foreign tax credit as opposed to being double taxed. Now, this probably doesn't come as much of a surprise, but moving down to the US can cause some big estate planning headaches for cross border retirees. First and foremost, one of the biggest mistakes that we see is when people don't redo their will or their trust when they move down to the United States. There's a really good possibility or probability that your will that you created up in Canada is no longer valid down here in the United States. A lot of states don't recognize Canadian wills, and as a result, it's very, very important that you redo your will once you come here to the United States. Now, this is even more important if you're a non-US green card holder or citizen. If you're simply a visa holder, it's very, very important that you go and get your estate plan done. And the reason why is as a visa holder, you may find that your estate tax exemption is only $60,000. And if you pass away with more than that, you may have a big estate tax bill, or your heirs may have that. As US green card holders or US citizens, we typically have exemptions up to about $15 million per person. So it's really important that you know that you are taking advantage of that higher estate tax exemption. It's really important that you update your wills and trust when you're down here in the States. Now, one of the biggest mistakes that we see is the failure to take advantage of the Social Security and coordination benefits. So in Canada, you're typically going to qualify for your Canada Pension Plan and Old Age Supplement. And then, of course, down here in the United States, you'll be eligible for a US Social Security benefit. Now, one of the mistakes we see is just not understanding how the totalization agreement works. For a lot of people, they don't even realize what benefits they qualify for. We see people forego or just don't turn on their OAS benefit a lot of times because maybe Service Canada told them they don't qualify for it, whereas we typically see most of our clients do qualify for OAS benefits. Another issue that we see is that people just don't quite realize what are they going to get. A lot of people are surprised when they start to put together just how large their CPP, OAS, and Social Security benefits are. A lot of times people, their first reaction is, Brian, if I would have known that I was going to get this much from the US and Canada, I would have retired years ago. Also, you want to make sure that you know what your spousal benefits are. You might be married, have a spouse here in the US, and they might qualify for a lot of Social Security benefits without ever even working here. So it's important to know what those are, input those, and make sure that they're part of your plan. Cross-border financial planning isn't just about taxes, it's about peace of mind. If you're a Canadian in the US, make sure that you subscribe for more insights. And check the description below for a free track checklist on cross-border financial essentials. Thanks for listening today.